Accounting is the language of business. You cannot order a dish from the menu if you cannot understand the language of the menu card. Similarly, you cannot understand what type of business you're buying in the stock market if you are completely unaware of the underlying concept of financial statements. As Warren Buffett puts it, "I don't read Playboy, I read financial statements." Now, you don't need to worry because you don't need a degree from the college in accounting or a lecture in math from that financial advisor of yours to understand what financial statements are all about. After all, we're going to make it easy for you guys. Welcome to 5-Star Finance, the place where we provide you with tools and knowledge so that you can achieve your financial freedom. Now, to begin with, let's just assume that you want to invest in a new business. You're looking to invest in a new restaurant in one of the quietest neighborhoods in the city, and that is going to be quite a challenge. Somehow you managed to put together the requisite capital you're going to invest in the business because there was something different about this business and you wanted to know if it was a buy or a pass. But before you make any decision regarding the investment, you need to learn the difference between the 3 common financial statements to understand the money problems surrounding your business, and these include the balance sheet, cash flow statement, and income statement. You need to understand these 3 statements from the get-go so that you can sort out all those money complexities in the future as well as the present. Starting up from the balance sheet. The balance sheet is actually a snapshot in time of the financial condition of the company. The income statement and the cash flow statement, on the other hand, explain what happened financially during a particular period, which is usually a quarter or a year. Investors can learn a great deal about a business by looking at the balance sheet. The balance sheet is a selfie of your physique during your workouts in the gymnasium, whereas the cash flow statements and the income statements are the training regimes and diets you were on during specific periods. To put it simply, there are 2 sides to a balance sheet, which include the assets and liabilities. When you are planning to invest in a business, you can evaluate its performance by viewing the balance sheet, as it will tell you about the financial position of that company by showing you the assets and liabilities its business contains. Let's suppose you are buying 100 shares of a company, and that means you will need to analyze the financial position of the company. You will need to see all of the assets as well as the liabilities so that they can cut off a deal. Investors can simply compare the current assets and the liabilities to determine the liquidity your business has, and the balance sheet will also enable them to calculate the rate at which the company generates its returns. Many investors compare 2 or more balance sheets from different periods to see if the business has grown over time or not. To put a long story short, the balance sheet has received its name because it must always be in balance. The asset side must be equal to the liabilities and shareholders' equities. The second important financial statement you need to wrap your head around is the cash flow statement. Cash flow statements are directly related to the business models. This also means that they manage finances by tracking the cash flow of an organization and helps in determining the company's performance. Coming back to the business which you are planning to invest in, you need to look out for the number of sales they're making, and is their business attaining any competitive advantage in the market or not. All the investments which are coming into that business are going to be denoted by the cash flow statement. This type of financial statement will revolve around the source of the income revolving around that business, and it will also help in enabling the businesses to set up cash forecasts for short-term planning. You might be wondering how this type of financial statement works, right? So when you are running a business, it is highly desirable to monitor the amount of money coming in and the amount of money going out. It should be understood that the income cash comes from operating activities, investing activities, and financial activities. This statement will also let you know about the cash outflows, such as salaries paid out to the staff and the dividends being given out to the shareholders, maintenance costs, taxes, and all kinds of stuff. To put a long story short, the information that you will obtain from the cash flow statements is beneficial for the management and regulation of a successful business. Ultimately, investors can find great businesses to invest in by analyzing the cash flow statements. One of the most important factors that the cash flow statement will help you regulate is the positive or the negative cash flow. Businesses usually aim to attain a positive cash flow so that they don't undergo some serious debt, and borrowing further money to keep the business growing becomes difficult. The most popular rule of thumb that you will learn from any successful businessman or a stock market investor is that a company should always have sufficient cash so that it can pay back those hefty bank loans, grow by investing in the business, and buying commodities to enhance the quality of the underlying business model. The third and final financial statement is the income statement. As the name gives us an idea that income statements are financial statements that let us know about the income and expenditures of a business. An income statement is a record of how net income or profit in a business was generated. You start with a company's revenues or sales and subtract its expenses. The income statement is sometimes referred to as the statement of revenue and expenses, which might be a more telling name. Investors can check whether the company is in a good position to grow and whether the company has enough cash flow to support its business or not. For example, when you're running a restaurant, you need to look out for things like hiring security, you need to pay those electricity bills, and vice versa. This is the reason that investors like analyzing income statements, as they're quite precise and are published quarterly or monthly, unlike other financial statements which are published annually. With frequent publishing, investors can have a good track of the companies, and this helps them make informed decisions. The income statement gives investors an overview of the business in which they're going to invest. When we look at the income statement closely, it includes a section on revenues and sales, providing investors with a detailed account of the gross sales made by the company. The second edition includes the COGS, cost of goods sold, revolving around the costs of goods being sold. The next section includes the gross profit, which is the net profit minus the amount expended on producing goods. Financial statements form a core part of any investor's journey to financial freedom through stock market investing. If you can look for those undervalued stocks by having a glimpse of one of these financial statements, then you're already halfway there. Making big profits depends on your ability to analyze business successfully, and that highlights the importance of understanding stocks. This is the reason we provided you guys with a free ebook in the comments section below, which will help you explain the 6 stock categories in detail. Check out this video we handpicked for you, and we'll see you in the next one.